Welcome to the Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with John Bull and Robert Salter.
Welcome to the Tax Factor, the UK's top tax podcast. I'm John Bull.
And I'm Robert Salter.
Well, the spring statement has sprung, and as quickly as it came, it went. I'm not really sure what else there is to say, as Heather and Nimesh so eloquently covered it all, as much as there was, last week. I guess the takeaway from both of them was, watch this space. Even the most optimistic commentator must agree it feels like there may be trouble ahead, and that was before the much-trailed Trump tariffs come to town. But Robert, as a seasoned commentator at Blick Rothenberg, I have to ask, what do you think of the spring statement?
Well, certainly in some ways it was a do-nothing budget. And there is a part of me, having lived in England for so long, that is kind of quite fond of the old British saying, keep calm and carry on. And basically, therefore, the do-nothing might have been the right approach. But I am a bit iffy on this one, I have to say. I do think there's going to be some heavy tax rises coming down the line in October when we have the budget. I think, obviously, a Trump house are going to only add to that. But just generally, I think it's going to be a very challenging position for the Chancellor. And I don't think there's going to be any easy options. I do think we have to have tax rises, I suspect. Clearly, still struggling as a country. They're struggling to hit their targets in many cases. All the ambition she had for getting additional tax revenues, I just don't think that's going to happen. It's very hard to achieve in reality. So I think we're in trouble.
You're right. We'll see what comes in October.
May we live in interesting times, as the old curse goes. Having said that, let's focus on something more important. The fact that we're getting close to the end of the UK tax year, which ends on the Saturday, the 5th of April. So are there any last-minute tax planning nuggets you would suggest, John?
Thanks, Robert. Yeah, lots of low-hanging fruit here. So to kick us off, in the first instance, individuals might consider maximising their allowances for the current tax year, primarily the personal allowance and the 20% basic rate tax band, particularly relevant for business owners who might consider extraction of profits from their company by way of dividend or employment income before the tax year closes. Secondly, if one's income is between £100,000 and £125,140 and therefore potentially facing a combined tax and NIC rate of 62%, consider ways to reduce taxable income, such as pension contributions or investing tax efficiently into EIS, SEIS, or VCT investments. For those with investments in taxable accounts, consider capital loss harvesting to offset gains realized during the year, but beware the bed and breakfasting rules which apply if investing in the same asset within a 30-day period. If you have any spare cash, have you maximized your £20,000 ISA allowance for the year, or the £9,000 junior ISA allowance for your children? Very much use it or lose it allowances. For an employer or business owner point of view, consider advancing payments to employees, e.g. bonuses, into the current UK tax year to bank a national insurance saving. You can find much more information on our website. Search for BR's Tax Planning Guide 2025.
Thanks for that, John. Now, obviously, given we're at the end of the tax year, it's probably a good time to kind of consider why the UK has this fairly peculiar tax year. And let's be honest, it is peculiar and odd and weird and very much kind of left field compared to the rest of the world. And it actually dates back to the Middle Ages. The tax year originally started on the 25th of March, or usually start linked to the 25th of March. It was meant to be a religious day, a religious festival. Not sure which one. Probably should have to check that out, but it definitely linked into a religious festival. And then when we changed to the Gregorian calendar, it moved to what was the 5th of April. And then because of the quirks of tax year ends and everything like that, it actually moved to the 6th of April. And it's basically been that since about 1800, which, like I say, is a bit strange. And especially if you think about it, we didn't actually historically have income tax as a fixed tax that was always there until the 1840s. Before that, it was something we had as a kind of an emergency system, for example, fighting the Napoleonic Wars and things like that. So the fact that we've got this, 5th of April year end is a bit strange. It's a bit odd. It doesn't actually work, I think, very well in the modern age. And certainly the old Office of Tax Simplification, which the government got rid of a couple of years ago, was very keen to move to a 31 December year end, or suggested that. And if you look at other countries like Ireland, they did it 20, 25 years ago, and it certainly worked in Ireland. And it would certainly make some of the international tax issues and tax treatments and everything like that a lot more logical and a lot clearer and a lot cleaner. Yes, it would come with some costs initially, I'm sure, but it is something I think that would help make the UK more attractive, more effective, and help taxpayers overall. So I'm a bit surprised it's not being mentioned more proactively. I think I can understand some people saying, oh, but it's the old system or I don't like change. But where change is better, it's the sort of thing I think we should be looking at more proactively.
Don't disagree, Robert. We should absolutely be looking to change, but I imagine it's that significant cost that comes into it, isn't it? it, at a point in time where purse strings are tight. I'm quite sure a change in tax year end hasn't had any airtime with Rachel Reeves or HMRC since the Labour government assumed power.
And it's definitely one of those which, is not an attractive thing in terms of it's not sexy. It is kind of mundane, it's admin type. It may be effective, it may be efficient, it may help, but it's not going to kind of get bonus points in the newspapers or anything like that. So, yeah, I can understand why they haven't pushed it.
Certainly is not. Sticking close to the tax year end, Robert, I know you wanted to talk briefly about the national minimum wage changes.
Obviously, the national minimum wage basically is now changed. So it's gone up to £12.21 an hour, which is a 6.7% rise, literally from the 1st of April. And that basically captures pay periods that start after that date. Now, the reality is, whilst you may think national minimum wage isn't a tax issue, it actually is. In that HMRC, for example, is the body that governs it, oversees it, makes sure the companies are following the regulations, and they're the ones who typically all kind of, press for payments, etc., where there's been misses or publicised the company names where they've missed them and things like that. And it's one of those things where there's lots of kind of innocent mistakes. So, for example, sometimes company data is often incomplete when it comes to date of birth for people and things like that. And so if you don't know if somebody's 20 or 21, obviously it's very easy to make mistakes as to what you should be paying them. Similarly, are you capturing overtime correctly? Because overtime, even when you've got salaried employees, is the sort of thing that does impact people's wage, and you need to make sure even salaried employees, for example, are being paid the correct minimum wage. And it's easy to make mistakes, especially where, for example, if you look at things on a seasonal basis, they may have very heavy periods of time and then much lighter periods of time. And if you looked at an annual basis, they may be fine, but if you looked at it purely on a shorter period, and if they then leave employment after 3 or 4 months of that period they've left, they may well be not, may well not pay the minimum wage for that period. So again, you can be cautious as a company. So there's lots of little foibles of the system that can catch people out quite easily. And like I say, it can come with quite a lot of negative publicity. So it is something that people need to be very aware of. Shifting gears across the pond, and this I think is something you'll be very interested in, John, as a US specialist. Liberation Day is the April the 2nd. So what do you think is going to be happening with Donald Trump and those tariffs?
Yes, we are back to tariffs, something we can't help but talk about at the minute. For the uninitiated, as a reminder, on 13th of February of this year, President Trump directed his staff to research custom reciprocal tariffs for every country, factoring in existing tariffs, trade balances, and value-added taxes, with a report initially due in 180 days. The team said a plan would be ready by 1st of April. No April Fools here. Trump later announced the reciprocal tariffs would take effect on the 2nd of April 2025, a day he nicknamed Liberation Day. Ensuing reports suggested trade officials struggled to design the tariffs because each of the 186 members of the World Customs Organization carried different duty rates. Quelle surprise. Officials subsequently told the media that the administration would focus on the US's largest trading partners and assign each an individualized rate, stating that just 10 or 15 countries were a concern. However, as recently as 30th of March, Trump told reporters, "I don't know who told you 10 or 15, dismissing the idea as a rumor and saying he intended to impose tariffs on all countries. The lack of clarity has led to high economic uncertainty and stock market declines, making March reportedly the worst month since December 2022 for the US stock market. It's expected that a number of massive tariffs will have been announced by the time you are listening. Everything from reciprocal tariffs on all countries, the enactment of delayed 25% tariffs on Mexico and Canada, tariffs on lumber, copper, pharmaceuticals, and microchips have all been proposed. Trump has, of course, already announced auto tariffs that are set to go into effect on the 3rd of April. So we watch with intrigue and in due course to consider both the wider economic impact of tariffs on British businesses and the effect that this may have on company transfer pricing requirements.
Absolutely, John. Even where, obviously, Keir Starmer was hoping the UK will avoid the worst of these tariffs, and to some extent I know there's negotiations going on and they'll probably go on whatever happens in these announced this evening. The reality is it is going to cause chaos for British firms and therefore British consumers and British taxpayers, and companies are going to have to look at their transfer pricing, as you say. They're going to have, to consider the whole supply chain realistically. Can they get stuff elsewhere? Can they make sure widgets come from other parts, etc.? And it's going to undermine confidence, and the less confidence you've got in the market, and it already has undermined confidence, the harder it is to get investment and make business cases to grow, etc. up to us. So it's going to be something which, for the Americans with Blitz, basically whatever, is going to have that element of uncertainty and that chaos. And again, may we live in interesting times, to go back to what I said earlier. Let's see. Anyway, obviously, we've talked about Trump, but obviously, if you're looking at it from a wider perspective, there's plenty of confusion in other parts of the US government these days. And one of the areas I'm kind of aware of is Social Security Administration and what the DOGE, the Department of Government Efficiency, is doing. So do you have any thoughts on that?
Yeah, thanks, Robert. I did talk a couple of weeks ago about cuts in the US Internal Revenue Service that were initiated by DOGE. But yes, they've got a plan to overhaul the US Social Security Administration as well by effectively gutting up to 12% of the Social Security Administration staff. This has resulted in a shuttering of local and regional offices, hindering phone services for beneficiaries, and generally destabilizing technology and operations. With the agency facing website crashes and overwhelmed call centers, millions of Americans are experiencing widespread access issues, leaving many struggling to resolve repayment problems. It really puts the challenges we have contacting HMRC here in the UK into perspective. Former White House official Julie Siegel, who served as Deputy Federal Chief Operating Officer at the Office of Management and Budget under the Biden administration until January, has been quoted as blaming staff cuts for these issues. She said, "You need actual human beings to operate the technology, and they keep firing people." Adding, under the current administration, staffing is down and technology is breaking, which, unsurprisingly, is resulting in lots of really angry customers. She added the issues with the technology were foreseeable, even for those without a background in tech. DOGE reportedly plans to go even further with its modernization efforts and overhaul much of the agency systems, with a plan to rapidly migrate IT systems. Whilst much of this undoubtedly is needed, experts believe that this migration could lead to errors in payments, including people not receiving benefits at all, on which many Americans living both in and outside the US heavily rely upon. Closer to home, we anticipate that we'll increasingly have problems in a couple of areas. First, applications for certificates of coverage. We suspect that these might be increasingly delayed and could in many cases create Social Security exposure in host jurisdictions like the UK. Secondly, negotiations between HMRC and the SSA, for example, on many cases which aren't directly covered by the US-UK totalization agreement, like some share option situations, may face significant delays and indeed may go increasingly unresolved.
Yes, it's definitely going to be something that's going to challenge a lot of people in unforeseen ways. For example, in many countries, when you send people on assignment from the US to UK or France or whatever, and you don't have that certificate of coverage, which is the official document which says you're not liable to Social Security in that host location, well, in many cases, the local authorities can say, well, you haven't got the certificate of coverage, therefore you are liable. So it could easily create double charges in some situations. Now, obviously, you would hope in many cases that if you get the certificate, albeit, 6 months down the line or 12 months down the line or whatever, you'd then be able to kind of claim back the social charges that you've paid in the host location incorrectly. But at the very least, that's a significant cash flow hit for a lot of companies. And again, when cash is tighter, it's not the sort of thing you want to be seeing happening. And there will be additional costs just because even if you're filing collector returns or whatever to get the Social Security back, it's still a cost. So, hey ho, may we live in interesting times. I'm starting to repeat myself here, so apologies. Okay, so shifting taxes and looking at VAT, which is obviously everybody's favourite tax. Everybody will recall that the concept of VAT on school fees has been a hot topic for a while now and was formally introduced from the start of January this year. People are paying that as we speak, but there's also been court action that's going on, and it's actually just started this week in terms of formally going to court, where we have Lord David Pannick KC actually arguing that the policy of VAT on school fees is in effect a breach of human rights because it impedes parents' ability, for example, to actually have an independent education for their children, and that is arguably a human right. And then there's also similar kind of cases which could go along in terms of faith schools, for example, and they may well go to court in due course, proposed to go to court. So at the moment, we've got all this decision making as to what will happen, what will it be. The cases are meant to be kind of high priority, so hopefully we'll get decisions reasonably quickly, because I think the idea is that at the very least, say by the summer, people know definitively what the final situation is. But there's an element of wait and see there. But it is interesting that in some ways it's taken a long time and it's going to take a bit more time. And I sometimes think that the only people winning from this are actually the lawyers. I'm not sure the government's going to get the money it says it's going to get. And certainly the uncertainty, I don't think is good for anybody. So any particular thoughts on that, John?
Thanks, Robert. Yeah, I'd certainly agree with that last sentiment. The uncertainty certainly isn't good for anyone. As a parent myself, I can certainly appreciate the arguments that are being put forward in contrary to, obviously, the government's position. As you said, we are hopeful that we'll have a speedy resolution, at least to give some people certainty.
The Tax Factor from Blick Rothenberg.
Well, that's all for this episode of The Tax Factor. As usual, our website has a comprehensive collection of regularly updated insights and analysis from our team. You can find the links on our homepage, blickrothenberg.com. If you want a break from budget and statements, try our sister podcast, Brave Business. We have a new episode available now, which takes a fascinating look at the topic of rapid scale-up businesses. Joining Declan Curry are Blick Rothenberg partner Stephanie Levin and guests Aidan Rushby, founder and CEO of car finance business Carmula, and Mike Williams, co-founder of Jamaican patty manufacturer Flake Bake.
Next week, and somebody clearly didn't think this through, dynamic duo Roger Holman and Neil Insall will be in the presenters' chairs, no doubt sharing more of their unique views and take on the week's tax news.
But from Robert and myself, it's goodbye.
Goodbye.
That's The Tax Factor. If you enjoyed The Tax Factor, please like, share and subscribe. Join us again next time on the UK's top tax podcast, The Tax Factor. The Tax Factor is a Blick Rothenberg production. Copyright 2025.